Welcome to Insights. I'm Eric. Thanks for stopping by today. We're going to talk about the economy in particular, where the U.S. government's going to release the GDP report coming out this week, and they're already conditioning people to think a certain way. I just posted up this tweet where we talk about expectations are that a recession is two negative quarters in a row, and then the government officials are basically saying this time around don't view that as a recession, although in the past it was considered a recession. Let's not take it as a recession this time. So other than something that you want to take it as a joke, I guess. I honestly, I consider the entire social media platform somewhat of a joke to begin with, and how everything becomes theater, and very little is taken in terms of understanding what's taking place. GDP is not a leading indicator. It's lagged badly. It's not useful. Anyone who's been watching The Matrix, who can look inside of it, see the economic activity composite, which we're going to show in a few seconds, we know that there's been a problem well in advance of this. It's and what kills me is that social media then rallies around this like this is somehow useful information, and somehow the public officials need to be that you expect them that somehow they're going to tell the truth. I've been doing this for 25 years, and I haven't seen anyone telling the truth ever. The whole reason I devised the Matrix and have a computer that's there to track and crunch the numbers and to analyze things is that human beings are going to shape perceptions over others in all facets of life, whether it be economic, social, political. That's all everyone does. And then the more you stand with the crowd, the more you feel you're a part of things, not even questioning what you're thinking and what you're doing. In many ways, when you find yourself thinking with the group or the crowd, whether it be in high school or in college or wherever you do, chances are you're likely wrong. And in this business of trading and investing, in the economy and everything related to that, you're standing with the crowd, you're going to lose money. So the crowd is being taught, or at least being conditioned, that GDP is contracting. It's not bad. Somehow this time is different. This is good. It doesn't matter. I really don't care what is being said out there. The whole point is to use the matrix in order to teach you how to read this stuff. So that's what we're going to end up doing inside the matrix, and I'm going to open up a quick version of it before we move on, and I'm going to slide down. The economic activity composite is down somewhere in this area here, right in here. It's line 100, 101. You click this link here, you're going to get an explanation of what's taking place in terms of how the EAC is calculated. It's either up or down, and it's a marginal activity, economic activity on the margin, which means it's going up or down. It's either accelerating or decelerating. It's not going to coincide with a recession or official recession in terms of GDP, because it's way ahead of that. The fact is that the current state or the EAC has been negative, and it's been dipping quite quickly. We're going to take a look at that. You can see the components of the EAC. Some of them are here. I do that in order to give myself a quick look at this. When I see this is labor, here's confidence apart, here's the federal budget, here's commodities. They're all part of economic activity. There's more than this as well. But in general, it's bearish. The computer calls it bearish U.S. Economic activity. I don't know how clear it has to be, other than the fact that you may not believe it. It's been like this for 4 weeks, so a good month. Now we're finally talking about the GDP is coming in weak. Well, it's a little late for that, I guess, but that's just how it works. So we'll head back here. I'm going to show you how the EAC is calculated. We've talked about this before. This is the long-term one, positioned against the S&P 500. This is the one we're going to focus on today. This is the EAC right here. This is ITCO and LTCO components of it. This is the fast-moving one. This is the slow-moving one. I have the computer highlighting when the LTCO is below zero. We're technically within a a difficult environment. That's longer term, that's slower moving. You can see this was well in advance. You can see where the economic activity was slowing and falling pretty sharply with little few marks in between where it was broken, but this is even faster. This is telling us that months ago we should be expecting a contraction in the US GDP. But then again, I said that was a real warning. This was a heads up. The economy is getting worse, but nobody really cared. I mean, nobody cares until the GDP goes down, and then after that, you say, well, why didn't someone tell us? Well, the fact is someone is telling you. It's really weak on both aspects. It's whether it's the ITCO or the LTCO. Prefer the LTCO, it's slower to move, but the ITCO, which is the intermediate term oscillator, that's the blue line. That's going to fall down first, and it's going to lead a lot of this. And you can see how it leads in the past, how it drops below, ahead of ahead of the LTCO, which is the longer term one. And it tells you that here's a soft spot, here's a big soft spot. Sometimes the economy drops and the stock market struggles, like it did here. Had a difficult time going higher. In general, when the economy is weak, the stock market is also weak or struggling unless there's a flight of safety concerned. And since nobody wants to go into the bond market, they tend to be favoring the stock market more and more, even if you do have a recession, which is we're going to have. I mean, most definitely, depending on how you calculate. And I'll move this back to the long term so we have less noise. How we calculate, this is one version of it. There's other versions too. And you can see that either within both aspects, whether we're looking at the budget oscillator as a part of this or leading tax receipts, the economy is still weakening, and it doesn't matter. You could see the blocks and a lot of red spots in here too. This economy is weakening. It's the same message we've been saying for weeks and really months, and nothing is really changing. So it doesn't matter whether or not they're going to define it as GDP. If you're at home or watching this video and you're in the United States or globally, you're going to feel it. I mean, you're going to feel it. The recession is coming, and a decrease in economic activity. Business is going to contract in. Jobs are going to be less plentiful. People are going to start to get laid off. This is not the big one. This is the softer economic decline, and there's a bigger one coming, and that's a couple years out still. But those are cycles. We're going to talk about those. But again, that's a cycle that's not going to take place until another year or two, and be lucky you can get consistent subscribers to return to this thing to listen to the message. So we're going to throw this out there. The GDP is, yes, it's going to be negative. This should be well known. Anyone who subscribes to the matrix, who has access here, can track this stuff ahead of time. You could talk about it here. The energy, whether this is the energy bill, this is the stock market, and different stability levels within it. Economic activity is another one of them, and I'm trying to look for it quickly. There's sentiment, economic activities down here. So just in case you don't know how to interpret all this, you come to the bottom section of the matrix and you see these are all warnings. And this is why there's a check box here. It's difficult for the stock market to rally when there's economic contraction that's taking place. Who cares if you call it a recession? Who cares if the Federal Reserve or the public policy officials will acknowledge it? It really doesn't matter. Market's efficient. That's what the EAC is based off of. Market real-time indicators, few of them. Many of them are not revised downward. GDP is often revised. Labor is revised. Labor is slow. They're not involved within the calculation of the EAC and how the computer tracks economic activity. If you have any comments or questions, let us know. If not, thanks for watching. Keep an eye on the economy here inside the matrix. It's probably not going to be too great for the rest of 2022. And then at some point it'll turn back up and things will do a little bit better, and then there's another drop that's coming later on. Thanks for watching, and we'll talk to you guys real soon.